Let me tell you something almost nobody has bothered to explain to you properly. This year, there are three pieces of genuine good news for American seniors. Three things with real money attached to them. And most people watching this will miss at least one of them, simply because nobody sat them down and explained it in plain words. You've spent months hearing nothing but bad news. The cost of everything going up, scam calls targeting your bank account, Medicare premiums climbing. I understand why you've come to expect nothing but trouble. But today is different, because everything I'm about to walk you through puts money back into your pocket rather than taking it out. And the third one in particular is the one almost nobody has caught on to yet. So stay with me to the end. I'm Linda Foster, and let me start with the first one straight away. If you're 65 or older, there's a new federal tax deduction worth $6,000. $12,000 if you're married and both of you qualify. This came from legislation passed in 2025, and it's specifically why the IRS has been actively running its own campaign this year, with the agency's own leadership personally visiting different states to make sure people know about it. This isn't a small print footnote. It's an additional $6,000 subtracted from your taxable income, stacked right on top of the standard deduction you already get, and on top of the existing extra deduction that's always been available to seniors. Let me put the actual numbers in front of you, because the real value of this surprises people once they see it written out. A 72-year-old individual filer earning $70,000 can claim a standard deduction of $15,750. Add the existing $2,000 senior deduction, plus this new $6,000 deduction, and the total comes to $23,750 in deductions. That brings their taxable income down to roughly $46,250, a meaningful reduction in what they actually owe. For a married couple where both spouses are 65 or older, you can claim up to $12,000 combined. And here's the part that genuinely surprises people. It applies whether you itemize your deductions or simply take the standard deduction. And it phases out gradually, not suddenly, above $75,000 for single filers or $150,000 for joint filers. This deduction runs through 2028, so it's not a one-year event. If you've already filed your 2025 return and you're not certain this was correctly applied, that's worth a direct conversation with whoever prepared your taxes, or with the IRS directly, because some preparers, particularly early in the filing season, we're still catching up with this new provision and may have missed it. That's the first surprise. Real money landing through your tax return that a meaningful number of people are going to miss simply because they assumed the rules hadn't changed. Now let me come to the second one, because this is money that a great many seniors are leaving on the table without ever knowing it was there. A significant number of states now offer property tax relief specifically for seniors, and unlike the federal deduction I just described, almost none of it applies automatically. At least 39 states plus Washington, D.C. have some form of senior property tax program, whether that's an exemption that reduces your home's taxable value, a freeze that locks your assessment so rising home values don't increase your bill, or in some states, a deferral that lets you postpone payment entirely until you sell or pass away. Here's who gets this. And this is where people wrongly count themselves out. You don't need to be struggling financially in most states to qualify. Many programs simply require you to be over a certain age, typically somewhere between 61 and 65, and to occupy the home as your primary residence. Some states do have income limits, but those limits are often considerably higher than people assume. In New York, under recently signed legislation, the senior exemption can now reduce your home's assessed value by up to 65%. Up from the previous 50% cap, potentially saving the average qualifying senior around $300 a year on top of what they were already saving. The trouble is that if your state or county doesn't proactively mail you anything about this, you may simply never hear about it. The action here is straightforward. Search your state's Department of Revenue or your local county assessor's website for the exact phrase, Senior Property Tax Exemption. Gather your photo ID, your prior year's tax return or Social Security statement, and your deed or mortgage statement, and file before your state's specific deadline. And let me tell you who this catches most often, because it's one of the more frustrating patterns I see. Somebody who's owned their home for 30 or 40 years, paid it off entirely, living comfortably but carefully on a fixed income, who simply assumes that because they don't fit some mental picture of financial hardship, none of this applies to them. That assumption alone is the only thing standing between them and a saving that, over 20 years of retirement, could add up to tens of thousands of dollars depending on their state. So that's the second surprise. Up to several $100s a year off your property tax bill. Available in the vast majority of states, but only if you ask, because nobody is going to chase you down to offer it. And that brings me to the third, which is genuinely the newest of the three, and the one almost nobody has caught on to yet. The third surprise involves a change to how Medicare premium corrections work, specifically connected to the same senior bonus deduction I described earlier. And it's a connection almost nobody is explaining clearly. Here's why this matters. Your Medicare Part B premium, including any income-related surcharge on top of the standard amount, is calculated based on your tax return from 2 years ago. If your income has genuinely dropped, perhaps because you retired, your premium may still reflect outdated, higher earnings. There's a specific form, SSA-44, that lets you ask Social Security to recalculate based on your current, lower income instead of waiting for the standard 2-year look-back to catch up naturally. Why does this matter so much right now? Because the new Senior Bonus Deduction directly reduces your adjusted gross income. And for some people, that reduction is large enough to drop them below an income threshold for Medicare premium surcharges that they were previously just above. This means the same $6,000 deduction that's already reducing your tax bill can also, for the right household, eliminate or reduce a Medicare premium surcharge they've been paying, sometimes worth several hundred to over $1,000 a year, simply because the deduction pushed their income low enough to cross back below a specific line. Think about what that actually means for somebody managing a tight monthly budget. A retired person whose income dropped after leaving full-time work, who's been quietly paying a higher Medicare premium based on income they haven't earned in over a year, may now find that filing this one form, citing both their retirement and the effect of the new deduction, brings real, ongoing monthly relief they didn't know was available. I've lost count of the number of people who tell me they checked their Medicare premium once, years ago, were told it was correct at the time, and never looked again. But the rules aren't frozen. The deduction is new. The thresholds matter differently than they did even 1 year ago. A household that didn't see any benefit from checking last year can easily see a real one this year, without anything in their own life having changed beyond this one piece of legislation. So here's what I want you to take from this third one. Don't assume you already know the answer, because the picture has genuinely shifted. If you've never filed Form SSA-44, or if you filed it years ago and assumed that settled the matter permanently, this is the year to look at it again, with your current numbers and this new deduction factored in. Now let me bring all three of these together so you can see exactly where you stand. The Senior Bonus Deduction, worth up to $6,000 for a single filer or $12,000 for a couple, through your federal tax return. Property tax relief, available in the overwhelming majority of states, worth anywhere from a few hundred to several $1,000s a year, depending on where you live and which program applies. And a real chance that this same deduction, combined with the SSA-44 form, could reduce or eliminate a Medicare premium surcharge you've been paying without realizing the connection existed. Stack those three together for the right household, and you're not talking about loose change. You're talking about the difference between a genuinely tight year and one where you can breathe a little easier. I want to say one thing plainly, because it's the thread running through all three of these. None of this is charity, and none of it requires you to feel uncomfortable about claiming it. You paid into this system. You've paid taxes your whole working life, and every single item I've described today exists specifically because lawmakers decided seniors in your exact situation deserved this relief. The only people who benefit when you don't claim it are the ones holding on to the money in the meantime. If you have family, a son, a daughter, a neighbor, anyone over 60 that you care about, send this to them today. There will be people in their lives sitting on money that's rightfully theirs. The deduction they didn't know existed, the property tax relief they assumed wasn't for them, the Medicare correction they never thought to revisit. A single message from you could be the thing that puts real money back where it belongs. If this was useful, share it with someone who needs to see it. Let me go considerably deeper into each of these, because the practical mechanics genuinely determine whether you successfully capture each one rather than simply hearing about it once and moving on. On the senior bonus deduction specifically, I want to address the cascading effect that makes this deduction worth more than its headline figure suggests for some households. Because it directly reduces your adjusted gross income, it can simultaneously affect two other calculations entirely separate from the deduction itself. First, your combined income for Social Security taxation purposes, which is your adjusted gross income plus tax-exempt interest plus half your Social Security benefit. If that combined figure crosses $25,000 as a single filer or $32,000 married, a portion of your Social Security becomes taxable. The senior bonus deduction, by lowering your AGI, can push that combined income back below the threshold for some people, eliminating taxation that would otherwise apply on top of the direct deduction savings. Second, your modified adjusted gross income for Medicare premium purposes, which I'll come back to in a moment when I talk about the third surprise in more detail. I also want to address something specific about timing for anyone who turns 65 partway through 2025. The eligibility rule for this deduction is based on your age as of December 31st of the tax year, not prorated by month. If you turned 65 at any point during 2025, even as late as December, you're entitled to the full $6,000 deduction for that entire tax year. Some tax software, particularly versions used early in the filing season before they'd been fully updated, incorrectly prorated this deduction for people who turned 65 mid-year. If your filed return shows a reduced amount and you were 65 by year end, that's worth correcting through an amended return using Form 1040-X, which has a deadline of 3 years from when you originally filed. On the property tax relief specifically, let me walk through what the actual application process looks like, since understanding the steps removes a lot of the hesitation people feel about whether it's worth the effort. You'll typically need a government-issued photo ID to prove your age, your prior year's tax return or Social Security statement to prove income where the program is income tested, your deed or mortgage statement to prove ownership, and a recent utility bill or voter registration to confirm residency. Gather these, then file before your specific state's deadline, which genuinely varies. Some states tie it to the general tax year, others to the property assessment appeal deadline specifically. After filing, follow up directly with the assessor's office to confirm your application was received and processed, and check your next tax bill specifically to verify the exemption actually appears on it. If your application is denied, you generally have the right to appeal, and in a meaningful number of cases, a denial reflects a simple paperwork issue rather than genuine ineligibility, which means requesting the specific reason for denial and correcting it is often all that's needed to get it approved on a second attempt. I want to flag the single most common mistake that costs people this saving every single year, assuming the exemption applies automatically once you turn the qualifying age. It does not, in any state. You must actively file, and in states with annual recertification requirements, you must refile every single year or risk losing the exemption without any prior warning, since most assessors' offices don't proactively remind you when a recertification deadline is approaching. Let me also address combining strategies, since this is genuinely worth understanding if your home's value seems disproportionately high compared to similar properties nearby. A senior exemption is a fixed reduction applied regardless of whether your underlying assessment is accurate in the first place. If your property is overassessed, the exemption reduces the bill slightly, but you're still being taxed on an inflated base figure underneath it. Filing a separate assessment appeal, correcting the underlying value, and then applying the senior exemption on top of that corrected figure delivers meaningfully larger combined savings than claiming the exemption alone while leaving an inaccurate assessment unchallenged. Now let me return to the third surprise and go considerably deeper, because this is genuinely the piece I think most people need to hear walked through with actual numbers rather than just in general terms. The Medicare Part B Premium Surcharge System, officially called IRMAA, the Income-Related Monthly Adjustment Amount, uses your tax return from 2 years ago to set this year's premium. Your 2026 premium is based on your 2024 tax return. If your income from 2024 was elevated, perhaps because you were still working full-time that year, and your actual current income is now considerably lower because you've since retired, You could be paying a premium surcharge right now based on money you simply aren't earning anymore. Here's where the connection to the senior bonus deduction becomes genuinely powerful. The deduction reduces your adjusted gross income directly. For someone whose modified adjusted gross income sits just above one of the IRMAA surcharge thresholds, this $6,000 reduction can be exactly enough to drop them back below that threshold, eliminating the surcharge entirely. The standard Medicare Part B premium in 2026 is $202.90 a month. Cross above the first income threshold, and an additional $81.10 gets added monthly. Cross higher thresholds, and the additional amount climbs considerably further. For a retired individual whose 2025 income, after applying the new senior bonus deduction, now sits below a threshold they were previously just above, filing Form SSA-44 and citing both their retirement and their updated lower income can mean recovering well over $900 a year in eliminated surcharge, simply by connecting two pieces of legislation that most people are processing completely separately in their minds. Let me walk through the practical filing process for this form in more detail. You'll need to identify the specific qualifying life-changing event, retirement being the most common, and the date it occurred. You'll need to estimate your current year's income, supported by documentation such as a letter from your former employer confirming your separation date, or your final pay stub. The form itself takes roughly 28 minutes to complete, according to the Social Security Administration's own estimate, once you have your documentation organized. And it's submitted by mail or in person at your local Social Security office, not online. I also want to address something specific about timing here, because it genuinely matters more than people initially realize. There's no requirement to wait any specific period after retiring before filing this form. And in fact, filing sooner rather than later is almost always the better approach, since the recalculation generally applies going forward from approval rather than retroactively covering months you already paid the higher premium. Every month you wait to file, after your income has genuinely already dropped, is a month you're potentially overpaying for no reason beyond simply not having gotten around to the paperwork yet. Let me bring all three of these together one more time with the complete numbers stacked up. The senior bonus deduction, worth up to $6,000 for a single filer or $12,000 for a married couple, directly through your federal tax return. Property tax relief, available in the overwhelming majority of states, worth anywhere from a few hundred to several $1,000s a year, depending on your specific location and program. And the Medicare premium correction through SSA-44, potentially worth several hundred to over $1,000 a year for anyone whose income has genuinely dropped and who hasn't yet connected this to the new deduction. For the right household, particularly someone who retired recently, owns their home, and has never specifically revisited their Medicare premium since the new deduction took effect, these three combined can represent thousands of dollars in a single year, money that was always legally theirs and simply required someone to walk through the connections clearly. I want to say one final thing plainly, because it's the thread running through everything I've covered today. None of this is charity, and none of it requires you to feel uncomfortable about claiming it. You've paid taxes your entire working life, and every single item I've described exists specifically because lawmakers decided seniors in your exact situation deserved this relief. The only people who benefit when you don't claim it are the ones holding on to the money in the meantime, whether that's an overpaid tax bill, an unclaimed property exemption, or a Medicare premium that's simply never been corrected. If you have family, a son, a daughter, a neighbor, anyone over 60 that you care about, send this to them today. There will be people in their lives sitting on money that's rightfully theirs, the deduction they didn't know existed, the property tax relief they assumed wasn't for them, the Medicare correction they never thought to revisit. A single message from you could be the thing that puts real, ongoing money back where it belongs. If this was useful, share it with someone who needs to see it. One final piece worth addressing before I close, since it comes up regularly when I talk through these three together with people. What if you've already filed your taxes for this year, and you're not sure whether the senior bonus deduction was correctly applied, or whether the cascading effects on Social Security taxation and Medicare premiums were properly considered. The straightforward answer is to pull out your filed 2025 return and look specifically for the deduction amount. A single filer 65 or older should see $6,000 reflected, on top of their standard deduction and the existing senior deduction. A married couple where both spouses qualify should see $12,000 combined. If the numbers on your actual return don't match what I've described today, that's worth a direct conversation with whoever prepared your taxes, or with a tax professional if you filed independently, since an amended return can recover whatever was missed. I also want to mention something specific for anyone who's self-employed or has irregular income in retirement, since the timing of when income counts can affect both the deductions phase-out calculation and the Medicare premium recalculation differently than for someone with predictable monthly pension or Social Security income alone. If your income varies meaningfully from year to year, working through these calculations with an actual tax professional rather than relying on general guidance, ensures the specific numbers are calculated correctly for your particular situation. Let me close with the complete picture one more time, briefly. 3 things, all genuinely worth checking this year. The Senior Bonus Deduction on your federal tax return, worth up to $6,000 or $12,000 depending on your filing status. Property tax relief available in nearly every state, worth checking directly with your county assessor, regardless of whether you assume you qualify or not. And the connection between this new deduction and your Medicare premium, specifically whether filing Form SSA-44 could now eliminate a surcharge that the deduction has pushed you below the threshold for. Thank you for spending this time with me today. If any part of this applies to your own situation, the most useful next step is picking just one of these 3 and actually checking it this week, rather than filing this information away as something to revisit eventually. I'll see you in the next one.